Dear friends, in the previous session we discussed about an introduction to leverages, what is the meaning of leverages, what is its significance, we discussed in the last session. Today we will be discussing about what are the different types of leverages. Having understood the fundamentals of leverages, now we will discuss in detail about the different types of leverages, and we will proceed further what it means and how to calculate these different types of leverages and how it is used, what is the significance of these different types of leverages in finance we will discuss. First of all, in the first session I mentioned about three different types of leverages. We have operating leverage, financial leverage and combined leverage. Now let us discuss about let us understand what is operating leverage. Operating leverage, in fact, it refers to the proportion of fixed cost in a company's total cost structure. That means in the total capital of the firm, total capital structure of a firm, what is the proportion of debt when compared to equity. So, what is the proportion of debt in the total capital of the firm is called as leverages. So, in that what is the proportion of fixed cost element in the total capital structure. The operating leverage takes place when a change in revenue produces a greater change in earnings before interest and tax. That means in the business, if fixed cost element is more, fixed cost element means, say for example, in the business operations. So, in a factory, in the business operations, if fixed cost incurred by the firm is high, for example, employee's salary is a fixed cost. It is not a fixed asset, but it is a fixed cost, employee's salary. Rent of a building and the various equipments used in the company for production, various equipments used in production, all these carries fixed cost. So, if this fixed cost is more, we say that the firm is using high operating leverage. If high operating leverage is used and if there is if high operating leverage is used, again I repeat, please try to understand the concept. If more salary is paid, then rent, various equipments, instead of manual machine, highly automatic machine is used. So, if automated machine is used, quite naturally that machine's cost will be high when compared to manual machine. If automated machine is used, the more number of units can be produced, wastage will be less number of people only is required to operate the machine. So many advantages are there. So, such kind of investments are made. We call it as the fixed cost is high. And what is the nature of this fixed cost? The fixed cost, total fixed cost remains the same up to the maximum capacity. Suppose a machinery can produce say 100 units a day. So, we invested in that machinery, we purchased that machinery and we made investment in that machinery. The machinery is capable to produce 100 units per day, but we are producing only 25 units. So, here why we are producing only 25 units, we have demand for only 25 units. So, there is no need to produce 100 units. If we produce 100 units, there is no demand. If that is the case, we produce only, say whatever demand is, the 25 units only we are producing. Whether we produce 25 units, 50 units or 100 units, the fixed cost remains the same, because we already made the investment. Employees are there, sufficient number of employees are there to produce 100 units per day, but since demand is only 25 units, we are producing only 25 units. But the employees are full-time permanent employees. So maybe because of some seasonal reasons or some reasons, if demand decreased, means still monthly salary has to be paid to the employees. So the concept of operating leverage is, in the business operations, if the investment in fixed cost elements, if it is high, the company is using high operating leverage. If high operating leverage is used, there should be effective utilization of all the resources, and we should try to increase the sales to the maximum. If sales is increased to the maximum level, then earnings before interest and tax, or profit from operations, operating profit we call it as, operating profit will be high. That is a concept of operating leverage. I hope it is clear to you. I repeat, if the business operations are done efficiently, then the operating profit will be maximum. Why? Because we will take only one example, that is the same example what I mentioned earlier. 100 units can be produced, we have employees, we have equipment, everything is there capable to produce 100 units per day. So already investment is made, fixed cost is there. What is the fixed cost? One element, let us understand one element. Salary to the employees is a fixed cost. Salary has to be paid, whether 100 units produced or 25 units produced, or we are not producing anything for 1 week, even then also salary has to be paid. So fixed cost is there. Fixed cost, for our example, for our easy understanding, let us consider the salary of employees. So salary of employees is a fixed cost. So if we produce 25 units, salary is the same. If you are producing and selling only 25 units, then what will happen? Salary, fixed cost has to be paid, operating leverage is high, but at the same time return is less, earnings is, or the revenue generated is less, because we sold only 25 units. But if you are able to sell 100 units per day, then there is increase in revenue, and thereby there will be higher percentage of increase in operating profit or EBIT. Why? Because when we sell product for 25 units, maybe 25 units sold for 50,000 rupees. If we are able to sell 100 units, then this 100 units will be sold for 2 lakhs rupees. Okay? So if you are selling only 25 units, the revenue is only 50,000. But the cost what we are incurring, say per day cost, let us take the example, in this example, per day cost all put together, salary all put together per day, we are incurring 60,000 rupees per day is the cost company is incurring for all together. So, we are producing only 25 units, but we have set up for producing 100 units. Okay. So, when we sell 25 units for rupees 50,000, that day we are incurring a cost of fixed cost of 60,000. So, it is a case of loss for us. Whereas, if we use the company's operations effectively, and if you are able to sell 100 units, we have the capacity to produce 100 units. So, we will be producing 100 units and selling 100 units means per day we will be generating a revenue of 2 lakhs rupees. Okay. So, 2 lakhs rupees when we generate, at that time also when the revenue is 2 lakhs rupees, the expenditure is the same. How much? 60,000 rupees is the expenditure or fixed cost, fixed cost, not all the expenditure, because when the number of units produced, the production increases, material cost and other overhead costs may increase. So, what we are talking about is fixed cost. The fixed cost element, the salary, rent, etc., etc., the fixed cost element will be the same. So, it will be it is the same as 60,000 rupees. So, when we generate a revenue of 2 lakhs rupees, still at that time also the fixed cost is 60,000 rupees. That means we will be generating a revenue of an operating profit EBIT of 1,60,000 rupees. This example, of course, it also contains other expenditures, tax implication, all these are there, but this is the best way to understand operating leverage. So, if fixed cost element is high, then company is using high operating leverage. If high operating leverage is used, then there is, if the revenue increases or if there is a small change in revenue, it produces a greater change in operating profit or EBIT. That is the concept of operating leverage. So, it indicates the impact of changes in sales on operating income. So, operating leverage talks about the impact of change in sales in operating income or EBIT. What kind of change will happen to operating profit with a given change in sales? So, a firm with high operating leverage has a relatively greater effect on EBIT for small change in sales. So, that means with a small, if a firm uses high operating leverage, a small change in sales will bring in greater change in earnings before interest and tax. Why? Because the reason is it is mentioned, the reason is mentioned at the end, it is mentioned, it is because of the fixed cost stay the same while revenue grows. So, in our example, whether 25 units are produced and sold or 100 units are sold, the fixed cost remains the same, total fixed cost remains the same, whatever there is no change in fixed cost, but because of that reason, when there is a small increase in sales revenue, there will be more increase, more proportion of increase in the earnings. Okay. So, it is a measure of how a company's fixed cost such as rent, salaries and equipments impact its profitability as sales grow. So, that is the concept of operating leverage. So, in short, operating leverage means if the company uses high cost in its high investment in fixed cost, then company is using high operating leverage. If high operating leverage is used, the small change in sales revenue will make a higher impact on operating income. So, high operating income means a company has a large proportion of fixed cost relative to variable cost. So, when sales increase, the company can generate significantly more profit, but if sales decreases, losses can also be magnified. So, low operating leverage means a company has a higher proportion of variable cost. So, its profits are less sensitive to changes in sales. So, the proportion of, you know, that selling price, you know, sales revenue, sales or selling price, how selling price is fixed, that you know, it is a selling price is equal to SP, selling price is equal to fixed cost plus variable cost, we get total cost, along with the total cost we add profit, then we get the selling price. So, here operating leverage means if the fixed cost is higher than the variable cost, then operating leverage is high. For example, selling price of a product is 10 rupees. The 10 rupees comprises of, say, 5 rupees fixed cost, 3 rupees variable cost, 2 rupees profit, sales 10 rupees, 5 plus 3, 8 plus 2, 10 rupees selling price. So, in this case, the fixed cost element is higher than the variable cost. So, operating leverage is high. So, in short, operating leverage shows how effectively a company can use its fixed cost to generate profits as sales rise. Here I have given one example of how operating leverage is calculated. You also should by heart this formula. Operating leverage, the formula for finding out operating leverage is equal to contribution divided by EBIT, contribution divided by earnings before interest and tax. What is this contribution? Contribution is the profit element plus fixed cost, because say contribution is calculated, contribution is equal to sales minus variable cost. When you deduct variable cost from the sales, then you get the contribution. So, in our example I mentioned fixed cost 5 rupees, variable cost 3 rupees, profit 2 rupees, total comes to 10 rupees as sales. In this example, how much is the contribution? Contribution is equal to sales minus variable cost. Sales is 10 rupees, variable cost is 3 rupees. So, 10 rupees minus 3 rupees, 7 rupees is the contribution. So, when you deduct variable cost from sales, we get contribution, means that contribution is equal to fixed cost plus profit. So, how much is fixed cost? 5 rupees, and profit is how much? 2 rupees. So, 5 plus 2, 7 rupees is the contribution. So, contribution is nothing but it is a sum total of fixed cost and the profit. So, in other words, fixed operating leverage, high operating leverage means fixed cost and fixed cost will be more, and there are chances of more increase in revenue or increase in profit. That is what we have we learned. So, when we calculate the operating leverage, first of all we should calculate the contribution. It is very easy to calculate. Contribution is equal to sales minus variable cost. Then that contribution divided by EBIT, that is earnings before interest and tax, then we get the operating leverage. So, operating leverage will be high provided if the contribution is higher than the EBIT, because contribution divided by EBIT is operating leverage. So, quite naturally if contribution is higher than EBIT, we say that the operating leverage is high, in which case contribution will be high. Contribution will be high if the fixed cost is high, then contribution will be high. So, anyway here one illustration is given. You can see sales 20,000 units at the rate of 8 rupees per unit. So, sales revenue will be 20,000 into 8, 1,60,000 rupees will be the sales revenue. Variable cost is 2 rupees per unit. So, variable cost 2 rupees per unit means 20,000 into 2, that is 40,000 rupees is the variable cost. So, here contribution is equal to, you can see 20,000 into 8, that is 1,60,000 minus variable cost 20,000 into 2, 40,000. So, 1,20,000 rupees is the contribution. Now, EBIT is equal to EBIT, earnings before interest and tax. EBIT is equal to sales minus total cost. EBIT or operating profit is equal to sales minus total cost. What is the total cost comprises of? Total cost comprises of variable cost plus fixed cost. Fixed cost plus variable cost is total cost. So, that means from the total sales revenue, if you deduct the total cost, in the previous example what I mentioned, 5 rupees fixed cost, 2 rupees variable cost, 3 rupees profit, total sales 10 rupees. From that 10 rupees sales, total cost is how much? Fixed cost plus variable cost. That means in our example, in that previous example 7 rupees, when you deduct that from sales, you get EBIT as 3 rupees. So, same is the case here. EBIT is equal to sales minus total cost. Total cost comprises of fixed cost plus variable cost. Sales we know, we calculated 20,000 into 8, 1,60,000 rupees is the sales, and variable cost also we calculated 20,000 into 2, 40,000. Fixed cost is given 30,000. So, 40,000 variable cost plus 30,000 fixed cost, that means 40 plus 30, 70,000. So, 1,60,000 minus 70,000, we get 90,000 rupees as the EBIT. Now, you can calculate operating leverage. It is very simple, easy to calculate. Operating leverage is equal to contribution divided by EBIT. Contribution we already calculated, contribution is 1,20,000. So, that divided by the operating profit 90,000, then we get the operating leverage as 1.33:1 or 1.33 times. So, operating leverage used by the company is 1.33 times. That is what it says. So, you can see operating leverage is 1.33 times because it is because the contribution is higher than the EBIT. Contribution is higher than the EBIT. So, the firm is using operating leverage. So, if firm is using higher operating leverage, a small change in sales revenue will make a bigger change in EBIT. That is what the concept of EBIT. So, so we can take financial decisions with the help of operating leverage. If you know what is the operating leverage, say 1.33 times or whatever, operating leverage, if we know, then we can estimate, suppose in the next year or in the next month, if we are able to increase the sales by 10%, what will be the change in EBIT we can estimate? How much would be the change in EBIT? Accordingly, we can take financial decisions like giving commission or incentives to the sales staff. How much should be fixed, how much incentive should be fixed for the sales staff for increasing the sales in the future. All that decisions can be taken based on operating leverage. So, please understand, I hope it is clear to you. Operating leverage is equal to contribution divided by EBIT. Contribution is nothing but fixed cost plus profit, or it can be calculated as contribution is equal to sales minus variable cost. Then earnings before interest and tax, EBIT, is equal to sales minus total cost. Total cost means fixed cost plus variable cost. Now, the higher the fixed cost a firm employs in the production process, the greater is its operating leverage. So, higher fixed costs are there, the operating leverage will be high. So, this concept is already been discussed in detail. A company with high operating leverage will experience larger changes in operating income for a given change in sales. There is another formula for degree of operating leverage. Degree of what is the percentage of degree of operating leverage. To calculate degree of operating leverage, the formula is percentage change in EBIT divided by percentage change in sales. Percentage change in EBIT divided by percentage change in sales. This formula also we can use if we have the information with respect to two periods, EBIT and sales is given, then the degree of operating leverage can be calculated as percentage change in EBIT divided by percentage change in sales. With this, we will conclude this session. In the next session, we will discuss about financial leverage. Thank you.